Now, the last source of capital that we're going to consider, or the most common, the third of the most common, big three, I guess, the most common capital sources for a firm is preferred stock. And remember, again, it's been a while, but all the way back to chapter 8 when we talked about stocks, we talked about a special kind of stock called preferred shares, where preferred shares act a little bit like debt and a little bit like equity. And that's because they have some special characteristics. The main one being that they pay a constant dividend in every period. Right? So preferred dividends are also announced in advance, and they're expected to be paid forever. So they act a little bit like debt in that when you buy a preferred share, you know what the dividend is going to be. You know that you're going to get it forever. So it's almost like the interest payments on a debt, which are known in advance. The only difference is that preferred dividends are still equity dividends, and that means they are able to be delayed indefinitely as long as the firm recognizes that they will have to make those dividend payments up if they start to pay dividends again. Right? And so this is how they straddle the world. They're still not a tax-deductible business cost, preferred dividends. They're still treated just like other common dividends. But this makes preferred stock a perpetuity. And so the perpetuity formula that says the price of a preferred share is equal to the dividend divided by the required rate of return can be rearranged just like the dividend growth model can be to say that the required return or the expected return of a preferred share is equal to the dividend divided by the price. Right? And so that's how we calculate the cost of preferred shares for a firm. And I'm going to, again, a really simple example here. We've worked a few of these, so I won't go over this in any more depth. And where are we headed with all this? Well, where we're headed is to calculate what's called the weighted average cost of capital, but which everybody just calls the WACC. And the WACC is the average cost of all the capital sources for the firm. Right? Particularly, it's the weighted average cost, which means we need to weight the costs by the relative capital structure percentages. Okay, so if our firm is mostly equity, then our weighted average cost of capital should be mostly dependent on what the equity cost is, and not as much on what the debt cost or preferred equity costs are. That's why we weight. Okay, so this is the return that will satisfy all of the firm's investors. And that's a really important thing because the firm uses the weighted average cost of capital as its required return, and that is its hurdle rate. So any project that doesn't provide a return greater than the WACC is not acceptable. And that means that and because we take in all of the equity cost, all of the financing costs, the capital costs together when we make that decision, everybody's happy as long as the firm is only taking projects that are greater than WACC. Okay, so to calculate WACC, we're going to need to estimate the weights, the capital structure weights. And the main thing here is that we make sure to use market values and not book values. And the way that we calculate market values for each source of financing is by multiplying the number of outstanding securities by the price per security. So for equity, that means we find the number of total outstanding shares. And outstanding shares, outstanding means publicly owned other than the company. So we just are counting all of the shares that are publicly owned by other investors. And then we multiply that by the current market price per share, which we just observe in the market. For debt, that means it's the number of outstanding bonds. And remember, individual bonds are only worth 1,000, right? They have a face value of 1,000. So and the firm might have thousands of those outstanding bonds. So again, we're just looking for the number of publicly owned bonds from investors outside the firm. We multiply that by the market price of the bond. The total value of the firm is then the market value of debt plus equity. And if we have preferred shares here, it's the number of outstanding preferred shares times the price per preferred share. And then the market value of the firm includes a third term here for debt plus equity plus preferred. Now the capital structure weights themselves are then the proportion of the total value of the firm that comes from equity and the proportion of the total value of the firm that comes from debt. And of course, if we have the preferred shares, it's the proportion of the total value of the firm that comes from preferred shares. And you can see an example of this here. Solutions in the slides, as always. And now we have all the pieces that we need to put it all together to calculate and estimate the weighted average cost of capital. And you can see that I've included all three terms here. So the weighted average cost of capital is equal to the weight of each source of financing times the cost of each source of financing, with one caveat, and that is we also include 1 minus the tax rate, because the cost of debt that we're actually interested in is the after-tax cost of debt. And so any project that doesn't generate a return greater than the WACC is probably not a good project for the firm to invest in, because it does not provide enough return to satisfy all its investors. And we have to take that into account, otherwise the firm is essentially losing money. All right, so we'll work a couple of big examples. The solutions are here in the slides. Also here in the slides are some tables from the book that go over cost of debt, cost of equity, and sort of reinforce all that I said. And the last thing that we want to talk about here is pretty important, and it's important because there is a few cases where the weighted average cost of capital is not the appropriate required rate of return for firms. Right? And that is mainly the case when we have big conglomerate firms. Okay? So another way to say it is that the WACC is only the appropriate required rate of return for projects that have the average level of risk as the firm. So the same risk as the firm's current operations. If we're looking at a project that doesn't have the same risk that the firm currently has, then we're going to have to make some adjustments to WACC to get an appropriate required rate of return for that project. Right? So if we have a firm with lots of different divisions, we can end up with some issues if we use the average risk, but our divisions have different levels of risk. So one of the ways to think about this difference is to say, think about an investment for a firm like Pizza Hut. Pizza Hut only does one thing. They make and sell pizzas. So their investments are going to be all in that realm. It might be opening up a new pizza store. It might be moving into a new country. It might be building a different location or upgrading some of their existing stores. It might be trying to come up with a new pizza that they're going to present. All of those could be investments, but all of those are exactly the same level of risk as their current operations. They're a pizza store. So all of those types of investments having to deal with operating a pizza store are perfectly in line with the risk of the general business. And that means the WACC is the appropriate required return for all those projects. On the other hand, we might have a company with lots of different divisions like General Electric. General Electric has divisions that run the entire gamut of production. They have light bulb divisions. They make all kinds of household appliances. They make washing machines. They make irons. They make all the way up to really complex commercial applications. They make wind turbines and MRI machines and nuclear submarines. Right? So they make everything all across. But what we have to recognize is that the average risk for those, for all those different divisions, is in the middle. That's what the average means. But the nuclear subdivision is significantly higher risk than the light bulb division. Right? The light bulb division is not that much affected by systematic risk. People are going to buy light bulbs when they need them. They don't buy more when times are good or less when times are bad. Right? You don't go around in the dark. You just go buy another light bulb. They're $1. On the other hand, nuclear subs or wind turbines or MRI machines are all pretty subject to the risks involved in the market. Hospitals aren't buying brand new MRI machines if the market has turned. They're buying it when times are good. Okay? So the risk for each of those divisions is going to be very specific to that division. And the average risk for all the firm is not going to be very helpful when we're trying to make decisions about about the individual projects for the individual divisions. And let me show you how that happens here. Okay? So let's assume we've got this project for we've got this firm with 3 different divisions, and each division is proposing a project. Right? Now, the average risk for the firm gives us a WACC. The average cost of capital for the firm gives us a WACC of 15%. And what we've been saying in this lecture is that this is the appropriate required return for all projects for the firm. But that's only true if all the projects have the same average level of risk. If the projects don't, if the divisions have different levels of risk, then we need to estimate the required return for each project, for each division, probably not each project, but for each division individually. Right? So if we have some divisions that have higher risk and some divisions that have lower risk, we're going to estimate those required returns separately from the WACC, usually with an adjustment to the WACC.